All right, welcome everyone. Just a bit of housekeeping before we jump right in. So this webinar is being recorded and we'll post the slides on the event page afterwards and email that to you. All participants are muted, but we very much welcome your questions and comments. So you'll see a question box, and when you type in a question, please be sure to include your name and organization. Feel free to type questions early. We'll go through the presentation and then leave plenty of time for Q&A. So if you want to queue up a question so that you have a better chance of our getting into it, we welcome that. And we are tweeting at hashtag mobility from poverty. So good afternoon or good morning, depending on where you are. My name is Lionel Foster, and I'm Communications Director for the U.S. Partnership on Mobility from Poverty. We are very excited because we have 300 registrants. For example, I see people from Albany, Duluth, Houston, New Haven, New York, Kansas City, Jackson, Mississippi, Philadelphia, Rochester, San Francisco, Warren, Pennsylvania, Washington, D.C. Now, I'm sure some of you are asking yourselves, is Brooklyn in the house? Yes, Bedford, Stuyvesant, Brooklyn is on the line. And I also see folks from Missouri and Virginia. That is by no means a complete list. It's just what I can make out from your organizational affiliations. Welcome. Thank you so much for joining us. This is part of a series of webinars from the U.S. Partnership on Mobility from Poverty. The partnership was founded 2 years ago to answer one big, bold question. What would it take to dramatically increase mobility from poverty? And the people who stepped up to answer that question are extraordinary. David Elwood, director of the Malcolm Weiner Center for Social Policy at Harvard University, is our chair. Nisha Patel, former director of the Office of Family Assistance within the U.S. Department of Health and Human Services, is our executive director. And the 24 partners are thinkers and doers. Among them are 5 MacArthur Genius Grant winners. They represent business, academia, the nonprofit sector, and the faith community. It's important to note that we are not a consensus group. The partnership is an incredibly fertile incubator of ideas, but the idea papers we've been publishing since January and will continue rolling out through April are each the work of their authors. There are, however, common principles and strategies that bind it all together. In the partnership's earliest deliberations, it became clear that, as one of our members, John Powell, said, poverty is not just a lack of money. So mobility from poverty requires more than moving $1 above the federal poverty level. Economic success is fundamental. Power and autonomy are also important, kind of knowing that you can shape the trajectory of your life. But it's not just about our lives as individuals. People talk about being valued in community as belonging, dignity, respect, social inclusion. So all of this was informed by conversations we've had with people around the country, and it really seems to resonate with diverse audiences. These 3 principles inform 5 interconnected strategies. The partnership's answer to that big, bold question, what would it take to dramatically increase mobility from poverty, is action in 5 areas: creating access to good jobs, ensuring zip code is not destiny, providing support that empowers people, change the narrative around poverty and mobility, and transforming data use. You can read more about this framework in Restoring the American Dream, What Would It Take to Dramatically Increase Mobility from Poverty at mobilitypartnership.org. Closing the financial services gap is part of our strategy to ensure zip code is not destiny. So before we discuss that, I will introduce our speakers. Bill Bynum is CEO of HOPE, a credit union, loan fund, and policy center dedicated to improving lives in the Mississippi Delta. And he's a member of the partnership who has led our thinking about the importance of access to capital at both the household and the community level. Ed Sivak is Executive Vice President of Policy and Communications for HOPE, and Diana Elliott is a Senior Research Associate in the Center on Labor, Human Services, and Population at the Urban Institute, where she studies families' financial security, economic mobility, and asset building and debt. So today you are in very capable hands. Bill, Ed, and Diana will talk about financial services, the link between financial services and upward mobility, access gaps, and recommendations to close that gaps. Then we'll leave plenty of time for Q&A. So I will turn it over to Bill, Ed, and Diana.
Thank you, Lionel, and good morning, everyone. Thank you for joining us. I want to start by thanking my co-authors, Diana and Ed, and acknowledge so many others who have contributed great value to this paper, not the least of which are my fellow partners. And while this is not a consensus, certainly, but it is clear that each of them brought valuable insights to this effort. As one who has spent his entire adult life in the South working to level the economic playing field in some of America's poorest places, I found it both an honor and an obligation to bring the perspective from the people and places where I've worked to the work that's being done by the Partnership on Mobility. I suspect that the focus of this ideas paper was not a surprise to people who knew me. I have to say, though, after 30 years of doing this work, I continue to be somewhat surprised that the critical role that financial services play in determining which people and places can climb the economic ladder is not more obvious. Quite frankly, while poverty is not just money, it is a complex, multifaceted issue. At its core, poverty is a financial construct, consequently ensuring that all people, regardless of where they live or who their parents were, have access to affordable, non-predatory financial services must be a central element of tackling poverty and fostering mobility. In this description of poverty, the World Bank says poverty is hunger, poverty is lack of shelter, poverty is being sick and not being able to see a doctor. Poverty is not having access to school and not knowing how to read. Poverty is not having a job. It's fear for the future, living one day at a time. In each and every one of these circumstances, access to financial services plays a major role in one's ability to escape from poverty. The diagram on this page attempts to illustrate this dynamic. When mobility is low, individuals and organizations that support them, such as social service agencies, focus on basic needs, food, shelter, and health. Mobility increases as people gain living wages and can save and accumulate assets. And institutions that facilitate mobility also evolve, from high-cost financial service providers to traditional banks and CDFIs, and ultimately institutions that manage wealth. The presence or absence of such institutions also signals how wide or how narrow the mobility path is in a community. This continuum also offers insights with regard to agency and autonomy, key power dynamics that influence economic mobility. As people and communities move toward the right side of the continuum, they exhibit more influence and control over their circumstances. Civic participation, volunteerism, involvement in the Parents-Teacher Association are higher for people who are banked. Homeowners vote at a higher rate than renters vote. So when we look at strategies to increase access to financial services, we need to understand that we're not just talking about programs to lower the rate of unbanked households or increase small business lending in underserved communities. We're also talking about dismantling systems that contribute to gross inequality and that have erected mobility barriers in our nation for centuries. With that, I'd like to go to the next slide and ask Ed to unpack the geography of poverty a bit more.
Good morning, and thank you, Bill. Thank you, Diana. Looking at these maps, we've got two maps side by side, one from the Equality of Opportunity Project, the other from Prosperity Now, the Assets and Opportunity Local Data Center. And what we see very quickly is not all communities have equal access to financial services. Areas experience the lowest levels of mobility in this country are also often the places that are among the most unbanked in the country. We could even go a step deeper and see that these places have the lowest rates of educational outcomes and health outcomes and higher rates of unemployment. Low mobility and financial services are inextricably connected. A closer look at the map on your left shows that there are pockets where mobility is least. The Mississippi Delta, Appalachia, Native American reservations. We know that as access to financial services declines, local people struggle to access financial tools that facilitate economic security and mobility, such as the ability to purchase a vehicle to go to work, which is especially relevant in rural communities, home ownership, small business development, all of these things. As we go to the next slide, we can actually see that if we look and contrast the highest mobility counties in the country with the lowest mobility counties in the country, that financial service access significantly lags financial service access across the country. There are significantly more bank branches in the highest mobility counties than there are in the lowest mobility counties. If you look at mortgage lending, similar findings that there's more mortgage lending in high mobility counties than in low mobility counties. And finally, if you look at small business lending, there are much higher rates of small business lending in high mobility counties than low mobility counties. We know that as the number of bank branches increases, poverty rates decrease, access to credit for mortgages and the cost of access to credit for mortgages rises, the cost of credit for mortgages decreases when a bank branch is present. In Appalachia, the National Community Reinvestment Coalition found that there's a positive relationship between the number of bank branches and the number of small business loans originated. And the Native American Bank was founded to address the lack of capital available in Indian communities, American Indian communities, which has spurred economic development. And I guess the last point I'd make before we transition to the next slide is to point out that we cannot be blind to the inequity that exists in the highest mobility counties, in the lowest mobility counties. If you look at the median white population in the highest mobility counties, it's over 95% compared to only 33% in the lowest mobility counties. On the next slide, we wanted to share with you, this is what mobility looks like. These are HOPE's members. What you see in the upper left-hand slide is one of our branches in Morehead, Mississippi. This is a small town of 2,000 people, majority African-American community, poverty rates over 40%. The building in the background was the last bank branch in town that was slated to close until HOPE had the opportunity to take it on. When we take it on, the Mayor Holland, who you see in the picture, asked for just a couple things: an ATM, the ability to apply for a loan or open a checking account. These were basic banking functions that weren't there prior to HOPE opening. I also want to point out that many of the local residents in this community engaged in money order banking. They would get paid at a local from their job. They would go to the gas station. They would cash their check, get the money they needed for the week, and get the rest in a money order. When the cash was up, the money order would be cashed, and then the amount needed for the next week would be taken out, and then another money order was purchased. So you can see how this would be a barrier to upward mobility. And on the right side, we got Chef Nick Wallace, another one of our members. When you talk to Mr. Wallace, he'll talk about how the majority of men in his life didn't make it past 42, and no one in his family had ever owned a business or a house. So he was the first one in his family to own a home, also financed by HOPE. In the bottom right-hand corner, you see Renee Brown and Stephanie Bach. They worked in a bakery on the Mississippi Gulf Coast for years, and when the owner was ready to retire, he offered it to them. The only problem was they didn't have the collateral or the assets to get a bank loan to buy it. Again, they came to HOPE. They've never missed a payment, and this fall they'll own that business free and clear. They own they employ 9 individuals. On the bottom left, you'll see a federally qualified health center in Jefferson County, Mississippi that we finance. This clinic is in one of the 25 poorest counties in America, a county that's 86% African American. The health center offers some of the only jobs in the county that pay living wages and offer health insurance. Also of importance, it's a place where people can access health care with dignity. HOPE's financing provided the resources to build a new health center in that place. And finally, in the middle, you'll see Raul Castro, who immigrated to the U.S. when he was 11. He was working in a restaurant, waiting tables and cut grass on the side. After a while, he was making more money with his lawn service business than he was waiting tables, and it started to grow. But he needed capital to grow his business, to get the bigger projects. And the bigger banks weren't in a place to provide him with the line of credit that he needed to compete for the bigger projects. Again, he came to Hope. Hope was able to provide the capital he needed. Today, he employs 6 people. So as we move into the recommendations and the work that Diana has done, know that they're grounded in our experience of using community development finance to create opportunity where it formerly did not exist, often with people and in places where they are too often overlooked and underserved. Okay, Diana, at this point, I'd like to turn it over to you to share some of the research that you have done on unbanked and underbanked.
Great, thanks, Ed. And as Ed just laid out, there's a tremendous amount of storytelling and sort of the real lives behind the scenes that are directly impacted by the infusion of capital and by access to financial services. So what we've done here and what I'm showing on this slide is exactly sort of the numbers and the magnitude of this issue. So what we show here is that, given the 15.6 million unbanked adults in the U.S., or those who have no formal relationship with a financial institution, their bottom lines are directly impacted by a lack of financial services, or at least safe and affordable financial services. So if we think about the unbanked, or those who underbanked, or those who have a bank account, they're also using alternative financial services. We don't show them on this slide, but about 1 in 4 households, or 1 in 4, or 33.5 million American households lack a formal relationship with a financial institution. That includes both the unbanked and the underbanked. And who are the underbanked? Well, half of households making less than $15,000 a year, and 1/3 of those making between $15,000 and $30,000 a year are either unbanked or underbanked. And the money that they spend on alternative financial service providers could be better directed towards their own mobility pathways. So we don't show this on this slide, but we conservatively estimate that if an unbanked adult used money orders, check cashers, payday lenders, and tax refund loans in a given year, they would lose $823 towards fees alone. This is a really, really large share of their household's annual income, considering many are making $15,000 a year or less, or even less than $30,000 a year. As this slide shows, the 15.6 million unbanked adults in the U.S. spend nearly $2 billion annually on high-cost financial products. Again, this is money that could be invested in their communities and also in their own and their family's economic mobility. But as this slide shows, it's lost to fees paid to alternative financial service providers. So this all speaks to a strong need for enhanced program and policy recommendations to address these household and community level gaps in financial services and economic mobility. And I'm going to turn this over now to Bill, who's going to talk a little bit more about these gaps and our recommendations.
Thank you, Diana. So what do we do about these gaps? Our research coalesced around 4 recommendations. And as you'll see as we walk through these, we don't believe you need to reinvent the wheel. What we need to do is to bring the wheel to more people and places. And so the first recommendation is to triple bank lending services and investment in underserved markets. Banks are, and for the foreseeable future will continue to be, the primary way that most Americans access financial services. Unfortunately, wide swaths of low-income, rural, and non-white Americans are outside the banking system looking in. Diana just went over the high percentage numbers of people who are unbanked or underbanked. almost 40% of the people who joined Hope Credit Union did not have a bank account before they joined our institution. The Community Reinvestment Act was created to balance the scales, but today the law is a dinosaur, based in an era when banks needed a branch to extract profits from a community. The more enlightened banks recognize the demographic shifts and understand that Black and brown and rural people are a growing market, and that failing to invest in underserved communities threatens the entire economy. These banks have developed products and services that level the playing field and invest in organizations that are more effective in serving low mobility people and places. Again, we recommend that banks triple the level of such investments in the nation's most vulnerable communities. As Congress and regulators consider the Community Reinvestment Act, we suggest that they evaluate ways to modify the law and strengthen its ability to increase the provision of financial services in low-income communities and communities of color, particularly in rural communities. Incentivizing and holding banks accountable for CRA service, lending, and investments, not only where they have a physical branch, but also where they lend and collect deposits, would benefit underbanked and low-income rural areas. Philanthropy also has a significant role here. They could support research and education that highlight which communities are least well served by CRA and what types of changes could increase the flow of capital into persistently poor communities. But banks will not solve the problem alone, which takes me to our next recommendation. Across the United States, there are approximately 1,100 community development financial institutions that have been certified by the Treasury Department as financial service providers that have a primary mission of community development and that leverage private and public resources to create economic opportunity in low-income communities. Services provided by CDFIs range from savings accounts to mortgages, loans for small businesses, and vital community facilities, including schools, grocery stores, and affordable housing, often referred to CDFIs as the Swiss Army knife of community development. The Opportunity Finance Network, the National Trade Association for CDFIs, reports that its members have invested $49 billion since the inception of the Treasury CDFI Fund in 1994. However, funding for CDFIs is woefully inadequate. While it's important, Treasury CDFI Fund is a relatively small resource. Each year, funding requests are more than 4 times the amount of funding that's available, and the program is consistently at risk in the federal appropriations process. And while our paper highlights incentives issued by banks and philanthropy that demonstrate opportunity and impact that can be achieved by investing in CDFIs, these resources are limited by the ways that banks apply the Community Reinvestment Act and by the disparities in philanthropic resources. The National Committee for Responsible Philanthropy reports that the per capita foundation given in the U.S. is $451. In New York City, it's $995. In Appalachia and the Delta, foundation giving per person is $41. $41 in the most persistently poor places in the country, as opposed to $1,000 in New York. We need to close these gaps. These are among the reasons that we recommend that philanthropy create a $1 billion fund to support the expansion and capacity building of CDFIs in low resource places like Indian Country, Appalachia, along the U.S.-Mexico border, the Deep South. These funds can be leveraged, every dollar can be leveraged 10 times by CDFIs, creating $10 billion in development finance opportunities in the nation's least mobile communities. And we urge the federal government to continue its support of CDFIs and to increase it. We recommend studying the impact on underserved communities of funding, increased funding for the CDFI fund at $1 billion. This is a level that will meet the demonstrated demand, and we also recommend that the CDFI continues its emphasis on persistent poverty places. Diana?
Thanks, Phil. I'm going to talk now about another recommendation that we make, which is establishing universal bank accounts for all Americans. So we recommend that encouraging or requiring all financial institutions that receive federal deposit insurance to offer customers a universal basic account or a free account that is simple, transparent, and does not charge overdraft or other hidden fees. So such accounts would ensure that all low-income Americans could have the access to the financial tools and protections in the banking system. And also importantly, as we demonstrated earlier, there are 15.6 million American adults who lack access to such services and pay hundreds of dollars a year and lose tens of thousands of dollars over their lifetimes. All of this money could be better directed towards underbanked Americans creating their own safety net and could potentially even decrease the need for public assistance. So we recommend that philanthropy could fund 2 demonstrations of the universal bank account proposal, for example, in a rural community, in an urban community, and couple this with a rigorous evaluation to determine the effects of increased account access on the mobility of families living in high poverty places. Furthermore, we also recommend that the government take a role in this as well. Federal banking regulators could convene community development stakeholders to develop, inform, and refine a proposal for universal basic accounts, one that wouldn't put the burden on any one institution but could spread it throughout the system. Congress could explore legislative options by holding hearings and/or requesting further study of the concept. So there's work that can be done here and promising strategies that could be implemented to help those and underbanked Americans. Ed?
And lastly, we are calling for the cultivation of a fair and responsible marketplace for all Americans. We must be conscious of the fact that any effort to massively increase access to financial services, particularly in low-income and underserved places, must be buttressed with a strong element of consumer protection. It was just a decade ago when the predatory mortgage industry nearly brought down our entire economy. And to that end, we call on philanthropy to invest in strategies that support continued innovation of financial services that are fair and responsible. We call for an awareness campaign to educate and inform vulnerable populations, youth, elderly, people of color, about the importance of having a non-predatory financial system. And finally, we call on government, legislative, executive branches, and federal regulators to develop solutions that encourage and incentivize service providers to protect consumers from abusive financial practices. This is, if we implement the first 3 recommendations without being cognizant of the importance of consumer protection to keep it all together, then a lot of these efforts could be for naught. So with that, I think we are ready to transition to questions.
Thanks so much to our presenters. So our participants, now it's your turn. We very much welcome your questions and comments. And thanks to those of you who have already submitted a few. We will get to them in just a bit. And when you enter a question, be sure to include your name and organization. So one question for our presenters: how feasible are these recommendations within the current political climate? I imagine a lot of people have been thinking about this as they've been listening. How willing would banks be to change how they fulfill their CRA obligations? And how willing do you think government would be to change the rules that around what it counts to meet your CRA obligations? Yeah, Bill, how about you start with that one?
Yeah, let me jump into that. I think we would all acknowledge that these are political times that we have not seen in a while. I think that the level of support and attention given to low-income communities, to issues of poverty, is not where we would all like it to be. But I also think that many banks have recognized the demographic trends, the fact that people of color will soon be the majority of the population. These are markets. They have a fiduciary responsibility to their shareholders to make sure that they are positioning themselves to be relevant to these markets. I think that positions the recommendations that we have made in a very strong place. I think that we see many banks, several banks, that have created programs that are doing a better job of serving low-income populations. Again, one of the challenges is that there are significant gaps. If the focus is only in their backyard, then that leaves large swaths of the population unserved. And I think that's where CDFIs can play a significant role. There's a long history of banks and CDFIs partnering. We need to take that to the level it needs to be to close these gaps.
Diana, you want to add anything to that?
Well, I'd say too that another element of this is that we can always try pilot projects right now, right? And again, philanthropy could fund some pilots in this area. So we don't necessarily have to wait for government to act during this climate, although that would be wonderful. There are avenues for philanthropy to help and to test some of these ideas now. And so we can sort of build the research and build the evidence in the meantime.
It is encouraging that a group of CDFIs from persistent poverty areas actually worked to unlock $500 million from the Department of Agriculture last year that previously was not made available to CDFIs to focus on persistent poverty areas. There's been language inserted into the USDA and Treasury budgets, putting a thumb on the scale in favor of persistent poverty places. And so while these are working around the edges, they're significant, and I think it shows that there is an understanding in Washington that these gaps need to be closed, and I think we have the track record and models that can help, that they can invest in and work to bring to scale.
Great. Got a question from Jennifer Medina with Prosperity Now. One of your recommendations is to triple bank lending services and investment in underserved markets. Why triple? So how did you come up with that level of an increase as opposed to, say, doubling or quadrupling the coverage?
On all of these recommendations, we wanted to set them at a level that would make a difference. And so, when we looked at bank lending, investment, services, and we wanted to set the bar high, and we felt like this was, there was both the capacity to deploy that level of resources, and then also the demand and the need in those areas. I actually believe that even if we hit all of those recommendations, shortly after this paper is released and this webinar is over, we're still going to have a lot more work to do in persistent poverty places and rural places. But again, we wanted to go, we wanted these recommendations to be bold and also of the scale to make a difference.
Great. Another question, you all are talking about bringing, in many cases, like physical locations to people in rural and other areas and underserved areas. But why doesn't, say, the fintech and online banking obviate the need for physical locations? Why isn't technology all of the solution?
I think Ed touched on this in his comments. The data clearly show that the presence of a bank branch in the community increases access to business capital. It increases access to affordable mortgages. Certainly there is an important role that fintech can play, but at some point, people need to have a place where they can safely deposit their funds and where they can go from a savings account and a checking account to and buy a car, which is clearly critical in rural areas as both a source of transportation to work and as a resource to support entrepreneurship. The Federal Reserve Bank made the point a while back that the absence of large segments of the population from the financial system limits their ability to use monetary policy to correct economic conditions. And so we really cannot afford to have so many low-income people, people of color, people in rural areas outside the banking system. It is and will continue to be the primary source of financial services in the country, and certainly not to dismiss the value of fintech, but we cannot have large segments of the population unbanked.
Yeah, and I'll add on to that, that there's also a lot of distrust. When you look at, for example, the FDIC survey of the unbanked, you find that 56% of the unbanked report that banks are not at all interested in serving households like theirs. So there's this perception that among the unbanked that banks do not serve them well. And I think what HOPE really demonstrates with their work is that they do serve them well through this physical presence. And I'll also add that the Federal Reserve 2016 Survey of Consumers and Mobile Financial Services finds that just 40% of the unbanked have a smartphone. So there's also this just gap in mobile services and smartphones as well, which I think has not been well addressed in the fintech conversation either. So I think there's this trust gap and also this technology gap.
Yeah, the good questions keep pouring in. I have one from Clolita Simpson. She says she's working to create a community development financial institution to service central and southern Illinois. The population is a mix of rural and small urban areas. There's lots of info on CDFI certification, but is there something of a primer available for how to create a CDFI from scratch? I think Bill and Ed, sounds like you might be able to tackle that one.
I think, fortunately, the industry has evolved a great bit since the mid-'90s, and there are experts around the country that could be helpful. I would start with the Opportunity Finance Network, and also the CDFI Fund has several resources that are available, including technical assistance awards to groups that want to start a CDFI. So I would go to CDFI Fund's website and also the Opportunity Finance Network as would be good starting points.
Great. I have a question from Brandy Payne with Housing Opportunities Made Equal of Virginia. So keep in mind this is within the housing context. What can we do today if we have clients who are unbanked? Is there anything we could do in addition to providing an education about non-predatory financial services options?
Again, I think that's part of what we are hoping to get at with our recommendations is, CDFIs are helpful when there is a CDFI in the market. The community development credit unions do a great job of providing basic retail consumer services, but banks have an obligation. They are federally insured. They take advantage of our tax dollars to grow and serve their shareholders. In return, they should be serving the communities where they extract profits. And so I think that there is it's really important that we engage banks in serving more of the population, and when they're not, then I think there are challenges. There's the National Community Reinvestment Coalition does a lot of good work around encouraging banks to pay attention to community needs.
Great. I have a question from Michelle Kofi Kumi from the Consumer Financial Protection Bureau. Does the partnership plan to respond to the recent revisions in the Dodd-Frank Act that eliminate racial reporting requirements, which could lead to racial discrimination? So let me offer a clarification, and then I'm especially interested in what Bill thinks on that. So the partnership our members work together to produce strategies and ideas. So that's the partnership identity on those strategies and ideas. But then, individual members have their own expertise and opinions on any number of issues that the partnership covers. So, Bill, I guess I would ask, in your perspective from Hope, how do you look at that? So the idea that recent revisions to the Dodd-Frank Act might eliminate racial reporting requirements.
No, that is something, quite frankly, we're quite concerned about. The overall direction of the Consumer Finance Protection Bureau in recent months is counter to the realities that we faced not that long ago. Again, as Ed mentioned, when the financial sector almost dragged down the economy because of the kind of financial abuses that the CFPB was created to address. I think when you look at the fact that $29 billion and 12 million people benefited. $29 billion was refunded to people as a result of CFPB actions because of abusive practices, and the 12 million people who were affected and reported abuses. It's clear that there's a need and a demand for an agency that protects consumers, and so that's part of what we're recommending, is that there are steps taken to ensure, and if it's not by the government, I think banks should be the front line of consumer protection. There are advocacy groups that are looking at CFPB and looking at consumer protections and considering what alternatives are to the current environment. But as you mentioned, Lionel, this is not a role that the partnership itself will take, but it's certainly critical to the issues that we're trying to address. Ed, is there anything you would add?
I mean, the other thing that I would add to this is, 3 out of 4 of Hope's mortgage borrowers are people of color. Roughly 8 out of 10 are first-time home buyers. Many are low income. Majority are women-headed households. And this is how these are our members. And in addition to expanding access to capital, credit, mortgage credit, our members have a very strong record of paying their mortgages. We have an incredibly low charge-off rate. So there's a need for mortgage lending in historically underserved places and among historically underserved populations. The provision that was referenced is critically important. If there's no reporting, even if we exempt a segment of the industry, it creates opportunities for discrimination, and that's something we are strongly against. So that's, again, we've taken the posture from the beginning that the CFPB was an incredibly important agency that provided protections that would not be provided, particularly at the state level in our region. And we're going to continue to advocate for a strong CFP and a strong level of consumer protection throughout all the regulatory agencies.
And again, just to clarify my numbers, the Bureau's 6-year report stated that CFPB's action resulted in $12 billion in relief for more than 29 million harmed customers. That says that it's a significant issue, and that did not go away within the last few months.
All right. I have a question from Anthony Newman. Bill and Ed, as you operate in rural settings, what has been your strategy to counter the narrative that poverty in rural places is somehow a result of choice instead of the result of historic systemic failure and inequality?
When you look at the place, part of it is by telling the stories that we told earlier. If you look at where, Hope made the decision to start in the Mississippi Delta And more recently, we've opened retail branches. These are in communities where we've got 2,000 people, very poor, but we see them as places of opportunity. In fact, we've doubled down in those places. We don't see Hope as a financial institution that's conducting transactions. We're involved in the business of transformation. When we go into a community, it's not just to open checking accounts. It's to sit down with local people and say, what are your hopes and dreams? What are your community development priorities for this place? And what we found is that people want affordable housing and a place to buy groceries. A high quality place for their children to be when they're at work. We've invested in this approach for our Small Towns Partnership. We've got 7 communities throughout the state of Mississippi, many in which we've got a branch where we convene local people, we have these conversations. And then as these priorities are identified, we do what CDFIs do best. We import capital into places where capital doesn't exist. It's been through this work that we've been able to right a number of historic wrongs. If you look at the community of Eastmoor is a community that was literally built on the other side of the town line of Moorhead to move Black people out of that town so that whites could hold on to a demographic majority to elect a white mayor. This was done in the late 70s. The result was these homes were literally thrown up overnight. And while they might have looked nice on the outside, on the inside, they were death traps. 20 of the homes of the 60 or so homes have burned to the ground. We've had individuals living in that community who have died, digging trenches to move the sewage out of their front lawn. Hope was able to work with a partner to get the resources in place to rebuild every single one of those homes to the standards of where it wouldn't burn down or be a threat of burning down. But most importantly, before we did that, we sat down with local people and we said, what do you want? What do you need? And having this conversation in the kitchen of a woman who was the head of the neighborhood association, a kitchen that didn't even have a ceiling because it had fallen in. She didn't say, I want a new house. She said, all I want is sidewalks without cracks so the elderly folks can walk and go see each other, and a playground for the children. So how do we combat that narrative? It's by lifting up the voices of local people and bringing the resources to the places that have been far too overlooked in a way that results in deep impact and empowers people to realize the vision that is their own.
One of the benefits of being on the Mobility Partnership is that you're exposed to incredible thinkers and doers. Raj Chetty's work shows that where someone grows up has an incredible influence on their ability to grow from the lower economic quintiles to the upper quintiles. And we have traveled from Bed-Stuy to East Palo Alto and Detroit and Cleveland and the Mississippi Delta. And the truth is that wherever we went, the same issues certainly arise: the need for housing, for jobs, desire for education as critical rungs on the economic ladder. But the availability of these resources vary dramatically from place to place, and their proximity to supports, the banks, the foundations that are willing to invest in creating those opportunity ladders varies dramatically when you go into places like Moorhead, Mississippi, as opposed to Brooklyn. And not to dismiss the needs in Brooklyn, they are significant, but again, the access to resources vary dramatically. And so I really appreciated the fact that the partnership is focusing not just on giving people options, the opportunity to move to more opportunity of strong communities, but also focusing on how do we improve conditions in opportunity deserts. And it's a both and I think that's that's critical. Some people do not want to move from their rural place. Place is important to rural people, and so we need to focus on how do we make sure that their children have opportunities to thrive and to stay and not to feel like they have to leave um, to achieve the American dream.
Yeah, great. We have another question. This one from actually a comment that I'll turn into a question. So from John Olson at FDIC, the Cities for Financial Empowerment CFE Fund has a template for national account standards for the unbanked and the underbanked, which promotes affordable, low-cost transaction accounts. And the FDIC promotes a low-cost, safe account template. So this is my elaboration on John's comment. So he gave an example of two organizations that have standards for accounts that can serve the unbanked and the underbanked. So my question for the authors of this proposal would be, is there any connection between what you're proposing and maybe some of these existing standards? Could it build on it? Could it strengthen some of what's already out there in the marketplace of ideas?
I think you hit it on the head, Lionel. I don't, again, we're not reinventing the wheel here. I think there are promising examples that have potential to scale and to grow, and that's really what we want to do. We want to light a fire under these issues and get others to agree on that it's important to ensure that all Americans have access to safe, affordable financial services, to work together to use this opportunity that's being presented by the Mobility Partnership. I think I don't know if you're going to mention the next steps in the Mobility Partnership's work, Lionel, but I think one of the things I hope that will come out of the idea papers and the May 3rd forum where the Mobility Partnership's work will be discussed is that we'll follow up on that and then take these ideas and convert them into action. And that we'll work together, taking advantage of other researchers and models to really see significant scaling of efforts that work.
Yeah, and just to tag on to that, this proposal and this recommendation is really complementary to, the work of CFE Fund and Bank On. We're not, advocating for anything more than scaling this, really. And as Ed said earlier, we were encouraged to think big with these recommendations and what would it really take to move the needle. And moving the needle would require a really big effort. So that's what we're putting forth here, sort of amplifying the work of others and saying, let's go big with this idea.
Great. And we'll do, I think, one or two more questions before we wrap up. And please do stay to the end, all of our participants, because I have an announcement about our May 3rd event in Washington, D.C. We'd love for as many of you as possible to attend. So this question comes from Omar Al-Alami from Onward Financial. How does a responsible organization like Hope Credit Union go from regional to national using the pathway suggested in this presentation? And I guess I would maybe add an addendum to Omar's question. So, Bill, if you've thought about that question specifically to Hope, I also wonder, is there something about the type of services that are needed where you need people with a local and regional focus? Might some organizations lose a bit of their touch, or if they try to go national? But I'll let you tackle that however you like.
No, thank you. It is certainly something that we have considered over the years, but we have learned that the closer you are to the ground, the more you understand the needs of those communities. We have staff that are residents of Itta Bena and Shaw and Drew and New Orleans and Central City in New Orleans and West Jackson, and it's those relationships and understanding of those communities that fuel our understanding and success. Certainly there's a role for national CDFIs, and we partner with those. But I think, again, the closer you are to the ground, the more likely you are to hit the target. And I think at their best, CDFIs are organizations that are closely connected to their communities.
Great. Well, again, I want to thank all of our speakers and all of our participants. Just a few notes as we conclude. Again, this was part of a series of webinars. Our next one is a week from today, Thursday, March 22nd, on 2 ideas under our strategy to provide support that empowers coach navigator models and home visiting programs. So please join us for that one. And there will be other webinars to be announced. And yeah, May 3rd, the morning of, that's Thursday, in Washington, D.C., will be our big culminating event. So the partnership has worked together, the members of the partnership have worked together for 2 years and come up with ideas like opening mobility pathways by closing the financial services gap. And on May 3rd, we'll look back on all those ideas, but maybe even more importantly, look forward to, as Bill said, how you move from ideas to action. So we'll be joined by a number of organizations that have contributed to some of the partnership's work and maybe even been inspired by the partnership's work. So we think about how you turn these principles and ideas into even better work on the ground. So that event page and registration page is on mobilitypartnership.org right now. So you can go there and register if you're in DC or can make it to DC. It'll be well worth your while. And I'll also say, if you like this webinar and want more news from the partnership in your inbox, please sign up for what's now our weekly newsletter. We are releasing so many things called the Partnership Post. If you go to mobilitypartnership.org and click on the sign up for our newsletter button near the top right, you'll be taken to the registration page, and you can get the latest news. So once again, thanks to our speakers. Thanks for so many of you around the country who tuned in and asked great questions. And we hope to see you again soon at another partnership event. Take care.